All right, we'll go ahead and get started. So again, thank you all for joining us. Today we're going to be talking about the tech in fintech, the data and algorithms that power the industry. For those of you who aren't familiar with us, we're a company called Yhat. We're based out of Brooklyn, New York, and our software lets companies integrate machine learning into their products. So we won't be doing a demo of our software today, but if that's something you're interested in, you can shoot us an email, info@yhathq.com. And down at the bottom of the slide, just some of the fintech companies, what we'll be focusing on today that we work with all over the world. Presenting today, we have our CTO and co-founder, Greg Lamp, who he'll be bringing his expertise and knowledge from working, of course, with all of these fintech companies, but actually has the experience from working as a data scientist at OnDeck as well, the internal experience, as well as Colin Rustig, who leads our product management team and was previously at PayJunction. So with that, we're going to go ahead and dive into it. You may have noticed down at the bottom just one last housekeeping note. There is a moderated chat. Feel free to submit any questions. We'll save a few minutes for Q&A at the end. And I already see, will there be a link to the slides after the presentation? There sure will. I'll send out the slides and this recording. So just quickly to go over what we're going to cover, Greg and Colin are going to give an intro to what fintech is. It's kind of this big industry buzzword, but what does it mean? Why is it different than finance? Then they'll dive into who the market leaders are, what they're doing differently, and what's caused them to have such success. And then finally, they'll wrap up with, if we're able to talk about these things and say, this really differentiates them and leads to growth, why isn't everyone doing that? So we'll talk about the challenges that fintech companies experience and some of the novel solutions they've come up with. So with that, I will hand it over to Greg.
All right, thanks, Elise. So quick primer, just for those of you who aren't necessarily working or familiar with the fintech space, give just a quick little background on what it is. So gist of fintech or financial technology is technology companies have started to emerge that are taking away business from large banks. So they're using data, technology, other resources to automate a lot of the heavy lifting that and the manual steps that are typically associated with banking products. And if you think about those products, or you think about a bank, traditionally they're composed of lots of different products or offerings. So it could be anything from a consumer loan or a home mortgage, all the way out down to investing and retirement advice, or even credit and data reporting for individuals or businesses. And what's happened is these financial technology or fintech companies have really started popping up in the past 5 to 10 years and started to eat away at the market share of these big banks. And the typical pattern is that one of these fintech companies will take on a single product or service that a bank provides and turn it into their own product, automate a lot of the decisions, automate a lot of the sort of necessary steps, and as a result are able to outcompete banks a lot of the time. So for today, we're actually going to be focusing on a particular use case of consumer and small business lending. It's a fairly common for, you've probably seen that some certain companies that are already doing this. Lending Club, OnDeck, as Elise mentioned earlier, where I come from, a lot of others, but the lessons and the ideas that we're going to be focusing on today can be applied to really any fintech business, whether it's a lender or not. So keep that in mind for when we're walking through the remainder of the presentation. I think lending is particularly interesting because the underlying product that these fintech companies, these alternative lenders, what they're delivering is inherently the same thing. it's just a loan or it's money. So at the end of the day, if you're taking money from a big bank like Wells Fargo, or you're taking money from a fintech company, it's still going to be worth the same amount, and there's not really any differentiation on the end deliverable product that you're purchasing. What I've also found to be really interesting is that the means of deploying that money or deploying that capital is also extremely similar. So if you log on to different alternative lending websites, generally speaking, they look fairly similar. You might have a company like Square that has a little bit better design sense and employs more UX experts, but ultimately, the user experience is relatively the same. It's going to be made up of some data collection, so getting some information from the user, processing that data, and then ultimately making a decision about that individual or about that small business and communicating it back to them. So I suppose that begs the question of, if the end deliverable is the same and the means of delivering that money or that capital is relatively the same, why are certain companies able to make better, or why are certain companies doing better than others? And ultimately, for lenders, it comes down to the data. So inherently, lending companies are making a lot of decisions about their customers. So that could be anything from how they target those customers to whether or not they're giving money to the right people, or how much money they're delivering. And those decisions are inherently tied to the data that they have about those individuals. And so the best companies that I've seen and that we've had that we've worked with as customers are using data in sort of different ways than a traditional bank. So if you can think about a bank or a traditional lender, they're using things like your FICO report, TransUnion, Equifax, Experian, those types of data sources in order to make lending decisions. But what some of the best fintech companies are doing is they're creating or consuming new sources of data. And I kind of break it down into two parts, or two types. The first type is the more differentiated, and that is collecting some sort of custom or proprietary data. So this is typically related to some sort of business model or technological innovation. So if you think about a company, again, like Square has their own chip reader that they can use to collect payments. That's an entirely new data source that they can then use to help make lending decisions and help make better decisions about their customers. And that's a data source that none of their competitors are going to have access to, and so it's going to make their decisions just that much better than the competition. The other type of data that typically see is sort of, a lot of times you might hear it be called like alternative data, can be often associated with social data or publicly available APIs. And that you can sort of think of as finding these non-traditional, bureau or credit data sources that can be used for helping to evaluate your customers. And so it obviously might not be quite as straightforward as something like a credit report where you say, oh, this person has a good credit score, they're probably going to be a good fit for our business or for our loan. It's going to be a lot harder to do that if you're looking at a company's LinkedIn page, or you're looking at a series of reviews that have been left about a business. But that's, again, we'll get to that a little bit later. That's one of the challenges that's associated with fintech companies. So, talked about all the sort of how there's all this data, there's all these decisions that are being made by each lender. And if we pull up a quick sample here, we're just looking at the Earnest application page. Earnest is a student loan refinancing company, but a lot of things are going on this page. Again, it's the same sort of standard web form. They're using it to collect information about a particular customer, but what you can see is that there's a lot going on under the hood. Everything from coming up with ways to target and market to the individual customer, personalizing the actual application, and then, of course, the actual credit and risk decision that's ultimately going to be made. And so all of these things are happening on the back end of that generic-looking application. And what we do now is sort of drill into each one of these items and talk a little bit about how they're unique and provide some examples of what they're like in the real world. So I mentioned it, but obviously marketing critical to really any company, but especially for financial services and fintech companies when ultimately the product is going to be really similar. It comes down to who can attract and make the best offers. And so marketing is super important for whether that's attributing your marketing spend to the actual customers that are taking loans from you, or whether that's using some advanced statistics and machine learning to segment out and figure out which customers are the best ones for you to target. So, previous experience doing this at On Deck, we were heavy users of sort of these alternative data sources that we could use as a cheap and easy way to identify potential new customers, evaluate their fit for our products, and then ultimately market them and go after the ones that felt like the best fit.
Another fairly common use case for marketing modeling or marketing algorithms is for purchasing leads from third-party vendors. So there are lots of companies that will sell you lists or often have real-time marketplaces where you can bid for, in like a financial marketplace, you can bid for people who are out shopping for loans and pay for those leads. So using modeling and algorithms, you can take advantage of those marketplaces to get the best leads for the best prices. So Greg talked about how with marketing, the objective is obviously to drive users to our page. But what happens once they arrive? How do we make a compelling user experience where they can navigate the complexities of financial products and understand what's going on? So one nice example of this is many of you, I'm sure, are familiar with Capital One. If you show up to a Capital One site, they probably have upwards of 50 different financial products that they offer. But what they'll do is take your personal information that they may buy from a third-party vendor, take geolocation data. So if I'm a male between 25 and 30 living in Southern California, I may be a good candidate for a car mortgage or a car loan. So taking that information and then changing the user experience can really help drive converting people who are maybe just shopping around into actual customers.
Yeah, I actually seen another sort of example of the customization with some of our customers. Really, the thing actually bothers me too on apps that I use, but if I'm logging into or returning to a website or an app, and I've already filled out some information, but the web app doesn't know about it, and they're treating me like I'm a brand new customer. That's super annoying, and that's something that the best fintech companies do a really good job of, is delineating between a new customer who is experiencing their application for the first time and a returning customer who's already familiar with the site, the product, maybe even is already a customer, and so can target and personalize their in-app experience accordingly.
So far, marketing and personalization modeling they're fairly above the board tasks. You see them as a user. Now we'll kind of move into some of the core modeling and algorithmic problems that you see in lending spaces. So how do we actually decide to issue an individual a line of credit? And the first part of those class of algorithms is fraud detection. So is someone trying to steal from me? Are they misrepresenting themselves? And often we see fraud broken down into kind of two categories. One is malicious, where they are blatantly trying to steal from you. And then the other is just a simple misrepresentation of maybe lying about their income, or I may list my home address as my mom's house as opposed to my own. It may even not be malicious, but it's just a genuine misrepresentation of data.
And our customers in particular have a lot of really interesting ways to kind of catch and identify fraud, anything from looking at particular IP ranges or blocks of IP addresses. That's something that's available just through the browser, and as it is, there are rings of fraudulent fraudulent people who kind of tend to hang out together on the web and have similar IP blocks, and it's really easy to catch some of them just by doing a simple lookup of, is this a suspicious IP address? Other things you can look at are kind of obvious, like the time of day. If someone's on your website at 4 a.m., that might be a little bit suspicious, or at least cause for concern. And then we actually have one customer who's doing something really cool. They actually look at the orientation of anyone that's on their site who's using a mobile phone. So whether it's in landscape or portrait mode, and they've identified that as a indicator for fraud, which I thought was pretty cool.
One of the reasons that fraud detection and fraud algorithms are so important is the core offering of much of fintech is the speed at which they can deploy capital. So if I show up at a lender's website, if I can go from start to finish in under 5 minutes, that's optimal for me as a customer, but also as for the company. So that's obviously in direct conflict with fraud. How do we both offer lines of credit extremely quickly, but ensure that we're not setting ourselves to be ripped off? So that's one of the most important parts of why fraud models matter so much.
Cool. So obviously it wouldn't be much of a lending company if there wasn't some sort of risk decision or credit risk model involved with the company. So at its core, this is answering the most basic question for any lender, which is, should I lend money to this person or this company? And for most of the lenders we work with, this is a decision that's composed of kind of two types of data. And this goes back a little bit to what we touched on earlier. But one type of data you've got is the sort of the clean, nice and organized credit bureau data. So that's going to be your TransUnion reports, maybe a FICO score, Equifax report, that kind of a thing. It's very nice and easy, consolidated, all aggregated for you, such that it's a lot easier to make a credit decision for an individual with that data. The other part, and this is where a lot of some of the fancy machine learning stuff comes into play, but is the kind of the alternative data sources that you might not typically associate with making a credit decision. So it could be anything from looking at someone's history on social media. You can use that as proxy variables, to anything from looking at someone's click history or web blogs on your website. And a lot of times this sort of inherently messy or not quite as neat nature of this data, it lends itself to using some more advanced algorithms. So anything from a basic logistic regression, but all the way to things like random forest or neural nets, or these sorts of techniques that can handle missing data points or handle even just non-standard distributions of data.
And imputation of missing data is one of the most challenging parts of lending to a new or potentially underserved market. How do we go enter into a new, say, geography where maybe people don't have traditional credit scores, or if we're trying to lend to students don't have credit history. So how do we find variables or other indicators to act as a credit score in a place where they don't exist? We have several customers who are doing really creative things in this space, using some advanced modeling techniques to impute both missing data, but as well as to find other data sources that can be used in lieu of a credit score. So one of our customers in Europe, they use a random forest model to impute missing credit data. So they can pull a report, and often those reports have missing values, and using these modeling techniques, they can kind of fill them in to provide a more robust score. Another of our customers that does something that's, again, very creative is using cell phone billing history as a way to pre-qualify customers. So as opposed to trying to impute values, they're able to take billing history, and they have a high degree of confidence that because that is such a strong predictor of creditworthiness, they can pre-qualify customers, shorten the length of the application, and ultimately deploy capital to that subset of users faster.
So we've talked about how we find customers. We've talked about how lenders determine whether those customers are real and a good fit for their products. But ultimately, in order for a transaction to occur, we need to find a way to identify the amount of money that someone's willing to pay for our product. And then, of course, we'll need to understand how that individual fits into our risk profile for our portfolio. So there's a lot that needs to go into this decision. It's obviously can be something that's determined by a company's credit committee or by the board, but at the sort of the basic level, what you're really asking is how likely is this individual to repay us, and how much added risk do they put on the portfolio? And so it's a really a big optimization problem of how can I market and sell to as many customers as possible without overextending my risk. And so there's a lot of cool ways that companies handle this, but I think one of the most interesting ones from our current customer base is they're actually using a neural net model under the hood that can in real time optimize their portfolio or optimize how they price individual loans based upon both the risk assessment of the individual, but then also simultaneously looking at their portfolio as a whole. And they're using the Google's TensorFlow neural net library to do all this. It's It's pretty cool. I think we actually have a case study coming out in a couple weeks on this one. So keep an eye out for that. So if we've given these sort of 5 key elements of decisions that are made at fintech or at lenders, seems like this is something that everyone should be doing, and again, kind of begs the question of the differentiation. Problem is, this can become a very hard thing to do very, very quickly. So let's kind of step back for a second and look at the 5 elements of a lender that we just talked about and dig in a little bit to what's actually happening. So from everything from marketing to fraud to actually risk and pricing, each one of those aspects is going to have its own source of data. So we talked earlier about kind of the alternative versus the traditional approaches to data sources. Might be using one, the other, both. And then there's got to be some sort of corresponding decision or algorithm that is using that data to make decisions and optimize for the business. Those algorithms and decision-making processes are typically done in some sort of language, some sort of like data science programming language like R or Python, and can require a team of data scientists and then ultimately engineers to actually take those decision-making processes and implement them or integrate them into the company's applications. And this is something that can oftentimes take weeks or months to do, and it's this act of kind of translating the business requirements and the business decision-making processes into that automated workflow that can be extremely time-consuming. And what trips people up a lot of times is that it's not just as simple as creating 5 decision-making processes and letting them out and putting them into the wild. Inherently, your marketing is going to affect how you personalize your application, and your fraud detection is going to impact your credit decisioning, which will impact your risk-based pricing, and so on. And so it's really more of like this web and entanglement of all of these elements kind of working together to service and recruit new customers. And what can ultimately happen is that this complexity gets magnified as the size or the scale of the business increases. So if you can think about the most basic case might be there's one application that his company is using. It might be it's a web app. Someone can log on, apply for a loan, and then get a decision quickly. But what happens if you have a sales force that needs to follow up with these customers? Now you need to integrate those same decision-making elements into your CRM, like Sugar CRM or Salesforce.com. And then your company keeps growing, and now all of a sudden you have a mobile app and a web app and a CRM, and you can kind of go from there, and you get the idea of this quickly becomes a very hairy problem, and heaven forbid you wind up operating in multiple countries. Now we've sort of multiplied all of these things together, and you could have dozens or even hundreds of these relationships and these kind of integrations and decision-making elements that you need in order to operate.
On top of that, we also have to be able to update all of these models regularly to reflect changes in credit policies or data sources available. We have engineering requirements to support, potentially hundreds of thousands of users running through our application process at a time. We need to be able to monitor all of our models, both statistically and from a web performance standard. And that basically it basically creates a massive amount of complexity. So with that, we'll move.
So with that, we wanted to obviously talk a little bit about our Science Ops product that can help with these problems. So we won't get too much into the weeds today. We mentioned it earlier, but if you'd like to sign up for a private demo, we're happy to do that. Just send us a chat in the webinar. But I will get into a little bit about how Science Ops can help manage and handle all these decision-making processes. So Science Ops, it's our flagship product, and it allows teams of data scientists to take the decision-making logic and models that they've created and integrate them or deploy them into production environments. So what you can think of is each one of those elements that we talked about earlier, we can take all of that, those data sources, the algorithms, the machine learning models that are associated with them, and turn them into a very isolated and easy to use service that you can integrate with the rest of your company.
Like Greg said, Science Ops lets you take these models and put them into production. It does that by taking statistical code in R and Python, bundling it all up, and then deploying it as an API endpoint. So algorithms can remain in their native language. What this allows you to do is use the latest and greatest in open source technology. We've mentioned TensorFlow a couple of times. There's a lot of great packages available in R, Keras, all of those. And those tools can now be used in production and power the kind of core decision-making logic that these models require.
Yeah, so one of the things that we kind of thought about first and foremost when building the product, and this is something that we struggled with at On Deck, was that these decision-making services and models, they're not static. They're inherently a sort of a living, breathing thing. They need to be updated. They need to be maintained. My first boss actually said, like, the moment you build a model that's the time when it's as good as it's ever going to be, and it's immediately going to start decaying. And so you need a way to monitor changes, monitor drift or shift in the model over time. And so that requires a way to quickly and easily refresh, retrain, redeploy these models without getting the entire IT team involved each time.
Lastly, one big concern for all of these fintech companies is the auditing process, specifically related to decision making. We've built that concern directly into the product by providing logging of inputs and outputs. All of that logging is model specific, so if I have credit models that are specific to Sweden, which are subject to regional regulation there, as well as models that are maybe specific to Spain or the US. All of that nuance can be encapsulated in one logging system where you can track inputs and outputs, see anything that goes amiss, as well as verify which version of a model that's deployed to production was actually responsible for the decision making that was received by the customer. So with that, we'll open it up for any questions. Again, Greg and I would be more than happy to talk to any of you on a demo and show you kind of more of the core of Science Ops. But at least I'll hand it off to you now.
Perfect. Thanks, guys. So far in the chat, I know we've gone a few minutes over, so thanks for your patience for those of you who are still with us. Hopefully you enjoyed the presentation. We'll stick around for a few minutes. If you do have questions, you can just type them in. So far, it's mostly just comments about cats and Science Ops. Thank you, Joe. It looks like a few people are typing in, so for those of you who want to stay on, feel free to. Otherwise, have a great day, and we hope to talk to you soon.